Welcome. Merrill Chandler here, your guide to the fundability universe. Welcome to the Fundability Podcast. I am Morpheus. You are Neo. And we are here to all of us level up our understanding of how this game is being played, how the funding game works, and what we can do to navigate the sometimes treacherous shoals that are associated with funding and the funding landmines that we must avoid. In this episode, we're going to be talking about a little known use of review scores, how review scores are used in soft pulls compared to hard pulls, and exactly why some credit cards will never, ever get a credit limit increase, even if you have a 800 plus credit profile. We'll see on the inside.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome, everybody. Merrill Chandler here, your host of the Fundability podcast. Now, we're going to do a kind of a deeper dive here. We've been talking about all kinds of things going on in the marketplace, the lender evolutions, right? What's going on with buy now, pay later, a lot of fascinating evolutions in the lender space. But one of the things that we had questions come in, and I wanted to make sure that I had a podcast on this particular topic. We had a client share their frustration because they had a Capital One credit card that was like a $500 limit, but the Capital One was never going, and one customer service rep even said, this credit card is never going to get its limit raised. It was $500 for over 10 years, $500. Why? We spend all of our time, energy, and resources at Get Fundable as part of this expansion of our fundability and getting more and higher approvals, right? We take great pride in getting those automatic limit increases. Well, why isn't Capital One in certain of their credit cards? Why aren't they giving credit limit increases? Why aren't you getting automatic ones? And then why can't you even get with an 800 plus credit score? Why can't you even get a manual increase in the limit? So let's cover that. I'm going to take us back to our podcast where we talk about mortgages. And mortgages basically create, and as a review, mortgages create an opportunity. Big mortgage banks, the mortgage bankers give a mortgage broker house, let's say $100 million in a credit line, and they fill up these credit lines with closed loans. So they use the credit line, they fund a real estate loan, pay off the seller, the buyer gets the new mortgage and gets the property, and that note goes in, uses the money from the credit line. So let's say there's let's say you have a $100 million deals, $100 $1 million fundings. So that 100 loan closings would fill up this $100 million line. They take that entire that entire credit line, they bundle it and turn it into a security, and then sell all the payments coming in from those 100 loans. They sell those payments to pension funds and long-term investors. Okay, that's called the secondary market. All right, secondary market. So the primary market, the retail market, is You and I go in, we get $1 million property, we finance with our good name and our positive, our fundability and our positive banking relationships and reputation. We get $1 million loan, and that loan is then bundled and sold to investors on the secondary market. Well, mortgages are not a loan. There are a number of, and they're more retail and marketing organizations like Capital One. Discover has been known to do this. American Express has been known to do this, but not as much as Capital One. So what happens is that Capital One for decades, I've been aware of this practice for at least 20 years, but Capital One will will offer a credit line. And so let's say Capital One sells 1 million $10,000 credit lines. 1 million 10,000 is 100 million. Yes. So they fill up an entire credit line with these credit card instruments. Instead of a mortgage, think of now you've got a $500 credit card, a $1,000 credit limit, or a $10,000 credit limit. They will never grow. Of those particular instruments get bundled together and sold to the secondary market, to long-term investors who are getting, if you look at the rates, 18% on the use of these cards. Does that make sense? 18 to 22% is what Capital One is charging. They're servicing. And then just like mortgage servicers, they send those payments to the institutions that made them into securities, and the long-term investors, instead of getting 2 and 3 and 4% on their money for mortgages, they're getting 18, 20, 22% on their money, because these credit cards, these credit lines have been sold. Now, the reason why they can't, because it is now been converted from a credit instrument into a security, and the security now collects money from the use of that credit card. The limit cannot be raised because it's in a fixed security. So if you've ever run into, especially Capital One, if you've ever run into a circumstance where they will not raise your credit limit, this is what's happening behind the scenes. All right. So we've got mortgages going on, and we've got credit line or credit limits are going through the same sales process and being sold into the secondary markets, and those secondary markets are then turning them into securities. Now, imagine you're an investor. You want a high ROI, go find Capital One credit instruments that are returning, because after the premiums and everything, 15 to 20%. That is a high ROI. So be careful. Now, there are other reasons why you may not get credit limit increases. It's all fine and good. And so let's review review scores, right? The FICO review scores. When you call up and say, hey, I would like to raise my credit limit, they're going to pull a review score first, and they're going to look to see if that review score is higher or lower than what they have from your last hard pull. Now, let's say the account's 3 years old. Your last hard pull may be from 3 years ago, but that's where they got all of the borrower behaviors and all of the internal performance data from your credit profile, right? So no matter how old it was or how the most recent hard pull was, they pull that data in. Then let's have the data over here. Then they're literally going to compare your soft pulls. Soft pulls don't count against you. You'll notice American Express does this. Capital One definitely does this. The big marketing firms, the depository banks don't do this as much. But American Express, Capital One, and Discover all ping with soft pulls to compare to see how your review scores stack up against your original score used for your application. If it's higher, they will evaluate giving you a small increase. But if it's lower, they reject you. They'll say, yep, nope, we're not going to give you a small increase. And if it's significantly lower, if your review scores are significantly lower, then they may actually contract or lower the limit or close the account. So that review score is used to measure against your that last hard inquiry, whether it's 3 months ago or 3 years ago. Now, once that occurs, if they say, oh yeah, let's say you have a $10,000 limit, and they're saying, we'll give you $11,000, we'll give you $1,000 more using your soft pull, because there's a differential between the last hard pull and, let's say, your new review score is higher. They'll say, yep, we'll give you $1,000. But if you do a hard pull and it gets you, your hard pull goes up, that's why they're able to give you a 3 or a 5 or even double your current credit limit, because you have a significantly more fundable credit score. Follow me? Remember, score is in charge of rate, term, and amount. So if your score, so that's the difference when you're going to raise your limits. They'll give you a little tiny bit for just a soft pull, just to compare it against the old score, because they haven't got the new data yet. So they're just comparing, oh, it's higher than the last one, we'll give them you a little bit. But if you get a new hard pull and it's higher, they're going to give you significantly higher approvals if it's significantly higher baseline score coming with a new application. So those two things are what are brought together in establishing what is the value you bring as a customer and as a credit user, card holder for each of these institutions. My name is Merrill Chandler. This is the Fundability Podcast, and I'm your guide, your Morpheus to awakening to the truth behind the lies we've been told, so that you can make the best and most powerful decisions for your future credit use. We'll see you next time.
Thank you for listening to the Get Fundable podcast. Please leave comments, because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast, because we want them to get fundable too.